Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$218.73. That's where First Solar, ticker FSLR, closed the session on Friday, February 6, 2026.
That is a brutal number to look at on the terminal.
It is a bloodbath. We are talking about a 6.7% decline day over day. And if you zoom out just a little bit, the stock is now down roughly 8.9% year to date. And this wasn't some quiet sell-off either. The volume was heavy, coming in at 5.26 million shares. We are now trading significantly off that late December 52-week high of 285.99.
It is technically in correction territory, and honestly, it's knocking on the door of a bear market trend. When you see a company with a market cap of $23.47 billion shed that kind of value so violently, the market is screaming that something is fundamentally broken. It feels like the air is being let out of the room.
Or it feels like the market is having a panic attack. And that is the central question we really need to wrestle with today. We have a massive divergence here. On one side, you have the market aggressively pricing in risk, fearing competition from Tesla, manufacturing defects. On the other, you have the fundamentals of the leading American solar manufacturer trading at multiples that look like a mistake.
I don't think it's a mistake. I'm taking the position that First Solar is shaping up to be a classic value trap. The metrics look cheap on the surface, sure, but the business is facing existential threats. Between the warranty charges on the Series 7 modules, significant insider selling, and the looming shadow of Tesla's 100-gigawatt expansion, the long-term growth story is just hitting a wall. The market isn't wrong, it's just finally paying attention to the risks.
And I am taking the other side of that trade. I believe this sell-off is irrational. First Solar is a strong buy. The balance sheet is pristine, an absolute fortress compared to the rest of the sector. The Made in America regulatory moat is wider than ever, and they just secured a patent victory that I believe the market is completely misunderstood or just ignored. This is a valuation reset offering a generational entry point.
Generational entry point, or catching a falling knife. Let's hear the case.
Let's start with the forest, not the trees. My core thesis rests on the fact that First Solar is not playing the same game as the rest of the industry. Everyone else, Jinko Solar, Canadian Solar, the rest of the pack, is fighting a commoditized war using crystalline silicon. First Solar uses cadmium telluride, or CDTE, thin film technology.
I want to pause you there. For the benefit of the listeners who aren't chemical engineers, why does that chemistry difference actually matter to the bottom line?
It matters because of supply chain independence. Crystalline silicon relies heavily on the polysilicon supply chain, and where does the vast majority of polysilicon come from? It comes from China, and specifically regions that are fraught with geopolitical landmines. The Uyghur Forced Labor Prevention Act, Foreign Entity of Concern restrictions. While competitors are scrambling to prove their supply chains are clean just to get their goods through U.S. customs, First Solar is vertically integrated. They don't have that risk. Their glass enters one end of the factory in Ohio or Alabama, and a finished module comes out the other.
Being unique is valuable, I grant you that. It keeps your containers from getting stuck at the port. But being unique doesn't matter if you aren't solvent.
But they are incredibly solvent. In a high-interest rate environment, cash is king. Look at the debt-to-equity ratio. First Solar is sitting at 0.03. That is practically zero debt. Now, compare that to their peers. Canadian Solar is sitting on a debt pile that exceeds its cash balance. SolarEdge is struggling with negative margins and cash burn. First Solar is the only one with a fortress balance sheet. They can fund their own expansion without going to the capital markets.
And yet, despite that fortress balance sheet, the stock drops.
Because the market is mispricing it. Look at the valuation. It is trading at a forward PE of roughly 10.2. But more importantly, look at the PEG ratio, price to earnings growth. It is at 0.30.
That is admittedly very low.
It's absurdly low. A PEG of 1 is considered fair value. They are trading at a 70% discount to their growth rate. For context, residential peers like Enphase trade at PEG ratios between 0.46 and 1.
You are paying significantly less for every unit of growth with First Solar. And with revenue growth hitting 79.7%, fueled by the Made in America credits, this company is firing on all cylinders.
You say firing on all cylinders, but I hear an engine that is starting to sputter. You mentioned the low valuation. In my experience, when a high-growth sector leader trades at a PE of 10, it's not a gift, it's a warning sign. The market is anticipating that future earnings will be lower than today's.
Based on what?
Based on the cracks in the manufacturing quality. Let's talk about the Series 7 warranty charge. The company recognized a $50 million charge and is anticipating another $56 to $100 million in liabilities.
That is a known issue, and it's already priced in.
Is it? Or is it a symptom of a larger problem? This charge stems from variability in the glass cleaning process and engineering performance margins. That sounds technical, but what it means is they are trying to scale manufacturing so fast that they are losing control of quality. This is the cockroach theory. If you see one $50 million defect charge, there are likely others hiding in the walls. You can't just wave away a 9-figure liability as a one-off event when you are ramping up new factories.
They have identified it and remediated it. They tightened the engineering controls.
Remediation doesn't fix the reputation damage. And frankly, the manufacturing issues pale in comparison to the external threat. We have to talk about the Tesla effect. BMO Capital downgraded First Solar specifically because of this. Elon Musk has outlined a plan for 100 gigawatts of capacity.
A plan is not a factory. Tesla has announced a lot of things that took a decade to arrive.
But the math is terrifying. If Tesla hits a terminal module price of 29 cents per watt, which is where their engineering roadmap leads, First Solar's pricing power evaporates. Management has already cut sales guidance to a range of 4.95 to 5.2 billion, down from 5.7 billion. They cut volume expectations too. When a growth company cuts volume guidance while a competitor threatens to flood the market with cheap supply, a 10 times PE isn't cheap. It's a repricing of a smaller, less profitable future.
I want to push back hard on this idea that Tesla or anyone else can just walk in and take First Solar's market share. You are ignoring the massive legal moat that was just cemented in January 2026.
You mean the patent ruling?
Exactly. This is the most underreported story in the sector. The USPTO, the U.S. Patent and Trademark Office, denied inter-parties review applications from Jinko Solar, Canadian Solar, and Mundra Solar.
Walk us through why that matters. Usually patent disputes are just noise in this industry.
This isn't noise, it's a blockade. The USPTO cited the settled expectations doctrine. In plain English, they essentially said the industry has relied on these patents for too long to challenge them now. They upheld First Solar's TOPCon patents, specifically U.S. patent numbers 913074 and 966732.
Okay, but TOPCon is the standard high-efficiency silicon cell technology used by almost everyone except for solar.
Correct. That is the irony and the brilliance of it. First Solar, the thin film company, holds the keys to the silicon technology used by its competitors. By upholding these patents, the USPTO has given First Solar a pharmaceutical-style licensing model. If you want to build high-efficiency TOPCon cells in the U.S., you effectively have to pay First Solar a toll. We are already seeing this with the 4-gigawatt licensing deal they signed with Talon PV.
So your argument is that even if they lose manufacturing market share, they make it up in royalties?
It creates a revenue stream with virtually 100% margin. The competition is now funding First Solar's R&D. That fundamentally changes the unit economics. It turns competitors into customers.
It is a clever legal maneuver, I will give you that. But I'm not convinced it saves them from the Tesla steamroller. Patents protect you from competitors using specific technologies. They do not protect you from a paradigm shift in manufacturing scale.
Scale takes time to build.
Tesla moves fast. First Solar is projecting about 26 gigawatts of capacity by the end of 2026. Tesla is targeting 100 gigawatts. Even if Tesla fails by 50%, they still have double the capacity of First Solar. In a commodity market, and let's be honest, at the utility scale, solar electrons are commodities. The lowest price wins.
Solar is not a pure commodity market when national security and tax credits are involved.
Utility scale developers have spreadsheets, not flags. If Tesla hits that 29 cents per watt price point, Do you really think a developer is going to care about First Solar's patents? They will buy the cheaper modules. Royalties from Talon PV are nice, but they won't replace the margins lost if the core manufacturing business gets commoditized by a player with deeper pockets and, frankly, better manufacturing engineering.
That assumes the only differentiator is price, but you are forgetting the Made in America premium, which is hard-coded into the tax law. This brings us to the manufacturing execution. They aren't just building factories, they are building a subsidy capture machine.
You are referring to the Inflation Reduction Act credits.
Specifically, the Section 45X credits. Look at their footprint. They have the Louisiana facility, a $1.1 billion investment in AI-enabled manufacturing. They have Alabama, but the genius move, the one the market is sleeping on, is the new strategy in Daphne, South Carolina.
The finishing facility?
Yes. It sounds boring, a finishing facility, but it is strategically brilliant. The Gaffney facility allows them to take Series 6 Plus modules, do the final assembly in the US, and arguably qualify for domestic content bonuses while avoiding tariffs. More importantly, it allows them to maximize those Section 45X manufacturing credits. We are talking about a margin boost of 11 to 17 cents per watt just from subsidies.
That is a massive number when you're talking about per watt economics.
It is a massive buffer. Even if Tesla drops prices, First Solar starts with a 17-cent head start provided by the U.S. government. That protects their gross margins against price compression, and the demand for this American-made product is robust across the political spectrum. Recent polling shows 70% of Republicans favor utility-scale solar if it is American-made. That provides a bipartisan shield for these subsidies.
I think you are being incredibly optimistic about political risk. You are basing a long-term investment thesis on the assumption that a government subsidy program will remain untouched forever.
It's law, not a suggestion.
Laws change, especially via budget reconciliation. If the political winds shift in Washington, the Inflation Reduction Act could be on the chopping block. If those Section 45X credits disappear, or even if they are just reduced, that 11 to 17 cent margin buffer you love so much vanishes overnight. And then what? You are left with a company whose core product is more expensive than the Chinese alternatives and the Tesla alternatives.
But the jobs are in red states: Ohio, Alabama, Louisiana. No politician is going to kill those factories.
Maybe, but let's look at the execution reality right now, regardless of politics. You mentioned the AI-enabled plant in Louisiana, but we have to go back to that Series 7 defect. The fact that they had variability in glass cleaning and engineering margins proves that scaling this fast comes at a cost. Things are breaking.
Growing pains. Every manufacturer has them.
Expensive pains. And demand isn't guaranteed. Look at the BP contract termination. That was a 6.6 gigawatt contract. Massive. And it got canceled. That proves that even with subsidies, if interest rates are high, projects die. The backlog isn't as ironclad as you think.
I have to correct you there. The BP cancellation was due to customer default, likely specific to BP's pivot away from renewables, not a lack of general market demand. First Solar's backlog still stands at a massive 53.7 gigawatts. That provides incredible visibility into future revenue. But I want to pivot to who is actually holding the stock, because the institutional moves tell a very different story than the headlines.
I'm curious who you think is the smart money here.
I'm looking at FMR LLC, Fidelity. In the fourth quarter of 2025, they didn't just hold, they increased their stake by 71.64%. They now own over 6.5 million shares.
That is a high conviction bet.
Exactly. When a shop like Fidelity increases a position by 70% in a single quarter, they aren't trading a technical bounce. They are positioning for a multi-year cycle. Currently, 98.46% of shares are institutionally owned. The institutions are consolidating ownership during this dip because they see the math: a 53 gigawatt backlog and an average selling price of 30.9 cents per watt. They know the spot price of Chinese modules is irrelevant if you can't import them.
Fidelity is smart, I won't argue that. But I look at the people who know the company better than any portfolio manager, the insiders. You cannot ignore the distribution pattern we saw leading up to this drop.
You mean the executive sales?
Yes. CEO Mark Whitmar and CCO Georges Anton sold shares we saw directors selling in the $260 to $270 range.
You know as well as I do that those were likely 10b5-1 plans. They are prearranged sales for diversification. It's standard corporate hygiene.
Prearranged is a convenient shield. They set those plans up to sell at those levels because they liked the price. If they believed the stock was going to $400 or $500 based on this massive backlog and patent moat, they wouldn't be selling substantial blocks at $260. Their actions signal that they viewed the stock as fully valued.
Or they have bills to pay and taxes to cover.
Perhaps. But combine that with the social sentiment. The retail hype cycle is dead. Media mentions are down 32.3%. The meme stock energy that drove it in 2025 has evaporated. So you have insiders selling into strength, and now retail is gone. That leaves the stock vulnerable to exactly the kind of correction we are seeing. It's a classic distribution pattern.
I actually view the drop in media mentions as a positive. The froth is gone. The tourists have left the building. Now we are left with the real investors, and a company trading at 10 times earnings with nearly 60% expected EPS growth.
Or we are left with a company where the narrative has shifted from unlimited growth to show me the money.
I think we have carved out the battle lines clearly here.
Indeed.
Let me summarize the bull case. We have seen a sharp correction, yes, but the business remains the only clean, scalable play on U.S. energy independence. The price drop is a reaction to conservative guidance, which, management often does to lower the bar. We are looking at expected EPS growth of 58.8% in 2026, targeting $23.23 per share. When you combine the patent protection acting as a toll booth, the tariff walls blocking China, and the manufacturing ramp-up in Louisiana and Alabama, First Solar is trading at a discount that simply doesn't make sense.
And my conclusion remains that the discount exists for a very good reason. The risks facing First Solar are structural, not temporary. The warranty costs on the Series 7 modules suggest deeper manufacturing issues. You call them growing pains, I call them liabilities. The competition from Tesla represents a cap on future pricing power that the market is finally acknowledging. And the reliance on the Inflation Reduction Act makes this a binary bet on U.S. politics. Until the Tesla effect is clarified and we see a clean quarter without warranty bleeding, this stock is dead money.
It's a battle between the balance sheet and the sentiment.
It always is.
That brings us to the end of this analysis of First Solar. We've covered the patent landscape, the manufacturing footprint, and the valuation disconnect. I encourage you to review the source material regarding the specific patent numbers and the facility details in Louisiana and Gaffney to form your own opinion.
Dig into those warranty accruals and the insider filings. There is always more to the story than just the PE ratio.
Thank you for listening.
Goodbye.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching, and see you in the next video.